Everyone is talking of a new global or international world order that is emerging as multilateralism, as we used to know it, crumbles, giving way to a different multipolar world ruled by more transactional instincts. The year 2026 will be one of important transitions as one gets better clarity on what the new normal could be. I prefer to refer to 2026 as the year of pragmatic transitions driven by the motivations, interests, and actions in a triangle of power featuring the West and its allies led by the US, the Eastern nations led by China and close allies like Russia and Iran, and the South, that is Africa, Latin America, Middle East. The East has found an opportunity to woo southern nations as US withdraws from agreements like AGOA, World Health Organization, and so on. And BRICS is extending its arms of friendship as it builds an alternative financial ecosystem to compete with Bretton Woods. France's President Emmanuel Macron recently warned of the risk of the disintegration of the international order that brought peace to the world for decades. This was as he met Xi Jinping in Beijing amid growing trade tensions between China and Europe, adding that the world has the responsibility to know how to overcome disagreements and leverage the many ways of achieving convergence towards a more effective multilateralism. Alexander Stubb, President of Finland and author of the forthcoming book, The Triangle of Power Rebalancing the New World Order, in an article in Foreign Affairs, wrote of three scenarios of a new global order that will gradually settle in and drive events over the next decades. The probability of occurrence of the scenarios will depend on events in the transitional period and especially in how today's multipolar arrangement evolves. What happens in the United States midterms? How aggressive is China going to be as multilateral checks and balances weaken? Which new powers will step into the vacuum created by the demise of multilateralism as we used to know it? Both Western and Eastern powers know they have to fight for the hearts and minds of the South, but doing that presents challenges as they also uphold their narrow national interests in a tougher geo-economic context. In the first scenario, Alexander Stubb predicts ongoing disorder and multipolarity with remnants of the old order and selective respect for international rules. This you could call business as usual or lingering transactionalism could become the new reality for a while. The political power shifts in upcoming US midterm elections is an important referendum on business as usual. The world has coped well, however, with this scenario, adjusting to the different global trade ecosystem with less costs than previously thought. This scenario may also be more short-lived as failures due to lighter rules eventually lead to calls to rebuild dismantled institutions. It could also be a path to the second scenario. The second scenario you could call reformed multilateralism or a different multilateralism, and it's one which has learned from gaps in post-World War II institutions that catered for narrow Western interests, but also one that recognizes that more advanced economies should not be subjected to unfair weights. For this scenario to happen, the major powers, the United States, China, Europe, have to see the upside of global collaboration on economic growth, for example, and want to agree a basis for a different pact that rewrites institutional rules like WTO rules and reforms UN governance ecosystems. Let's just say this scenario is, from what we know today, least likely for now. The third scenario is further erosion of international order, its rules and institutions, leading to a collapse and inability to solve acute crises or conflicts. Stubb says in this scenario that strong men and non-state actors will be able to fill power vacuums left behind receding international organizations, and many would say that this has the lowest probability of occurring, but this cannot be ruled out. Whether the world lands on an extended period of multipolar disorder or a reformed multilateralism depends on many unknowns, and 2026 will clear some of the fog. The uncertainty means business needs to be highly flexible, being ready for anything, and suggests more than adequate balance sheet buffers, strengthening its core business, going back to fundamentals, and ensuring innovation is well anchored on buyer needs and value. Throughout 2025, resilience has been key for businesses worldwide as they faced challenges including shifting national and global geopolitics, some still coming out of COVID-related fiscal challenges, conflicts like Ukraine, Russia, and Israel, Gaza, and insecurity in Africa. Companies that concentrated on strengthening performance on carefully identified and stable success factors were able to grow market share, milking new opportunities. Ongoing supply chain recalibration and new technology adoption will continue to present significant business opportunities in the evolving triangle of power, as the times, of course, will be calling for much more geopolitical vigilance. Hello, this is Global Business Insight, and I'm Bode Oshosami, here to discuss perspectives on the main headlines as it affects global business. To more business stories, on Wall Street, stocks closed higher as the weak private sector jobs data from ADP strengthened the chances that the Federal Reserve will cut interest rates on December 10. Private employers in the US unexpectedly shed 32,000 jobs in November as smaller companies cut back on positions. Dow Jones Industrial Average gained 0.86%, S&P 500 traded up 0.3%, while the Nasdaq Composite also added 0.17% as at close yesterday. Still in the US, Trump has loosened, in his words, ridiculously burdensome fuel efficiency standards for American cars.
He has observed tailpipe emission standards, one of the most important things that I've never had a group of people come to me more powerfully and really just devastated that they had to do it. It was killing them than the automobile manufacturers, the tailpipe emission standards, and it's driving the cost through the roof. And we revoked Biden's emissions waiver for California so that California communists could not regulate the automobile industry and ruin the entire nation of automobiles. And they were doing that too. But we have that now under control also with your governor, who's got much more than he can control. Now, under the new rules being issued today by Secretary Duffy, the Department of Transportation will rescind the Biden fuel economy prices. They were anti-economy. They were horrible what they were doing to the costs and actually making the car much worse. But these policies forced automakers to build cars using expensive technologies that drove up costs, drove up prices, and made the car much worse. The action is expected to save the typical consumer at least $1,000 off the price of a new car, and we think substantially more than that. Under the Trump administration, $70 billion are now being invested in the American auto industry. Ford has announced it will invest $5 billion across its Kentucky and Michigan plants. Is that a correct statement?
The new policy would require car makers to reach an average fuel efficiency of 34.5 miles per gallon across their fleet by 2031, down from the earlier target of 50.4. Car makers, including Jim Farley, the head of Ford, were obviously delighted, and they applauded the announcement at the White House. In the UK, the pound jumped against the dollar on course for its strongest day since May yesterday, as concerns ahead of last week's budget eased, and stronger economic activity data led to unwinding of many negative bets on the currency. The S&P Global UK Composite Purchasing Managers Index for November came in at 51.2, better than expectations of 50.5. Safaricom said late Wednesday that Kenya is selling a 15% stake in the telecom operator to South Africa's Vodacom for about $1.6 billion. This is as President William Ruto's government, facing high public debt, limited room to raise taxes, and annual debt repayments that absorb 40% of revenues, is forced to improve fiscal buffers by offloading some state assets. Inflation in Ghana fell for the 11th consecutive month, reaching its lowest level in nearly 7 years, with annual inflation dropping to 6.3% in November. This was according to government statistician Al-Hassan Idrisu while speaking to journalists on Wednesday in Accra. And in Nigeria, the central bank on Tuesday announced sweeping changes to its cash management policies. Stricter withdrawal limits were introduced and fees on excess deposits were scrapped in a bid to curb cash dependency and tackle security and money laundering risks. The Central Bank of Nigeria also, in a circular, said that effective January 1, 2026, individuals will be limited to cumulative weekly withdrawals of 500,000 naira, corporates 5 million naira. Withdrawals above these thresholds will attract fees of 3% for individuals and 5% for corporates. Still in Nigeria, the cabinet has signed off on a medium-term fiscal plan that projects spending of around 54.5 trillion naira, that's $37.71 billion in 2026. According to the Minister of Budget and Planning, Atiku Bagudu, the plan forecasts total federal revenue of 34.33 trillion naira, leaving a 3.61% of GDP deficit, with debt service costs estimated at 15.9 trillion naira. That's a crippling 46% of federal revenue. South African business confidence climbed 5 points in the fourth quarter after 2 consecutive declines and stood at 44 points in the quarter ending December, also 3 points above its long-term average. This was according to a survey by the Rand Merchant Bank that was compiled by the Bureau of Economic Research. The only sector to register a decline in confidence was building contractors, where sentiment moved 7 points lower to 39 points. In Australia, the internet regulator said a recent teen social media ban would be the first domino to fall in a global push to rein in big tech firms. Meta's Instagram, Facebook, and Threads have started locking out hundreds of thousands of accounts ahead of a deadline next week. Safety Commissioner Julie Inman-Grant said she had come to embrace blocking under 16s from social media after incremental regulatory changes were proving not to be effective in protecting the younger population. Crude oil prices inched higher after Ukrainian attacks on Russia's oil infrastructure signaled possible supply constraints. Stalled peace talks between Russia and Ukraine tempered market expectations of a deal restoring Russian oil flows to global markets, though weak fundamentals kept gains limited. Brent crude was just over $63 per barrel. Asia-Pacific markets were mostly higher after Wall Street gained on hopes the Federal Reserve could cut interest rates next week following weaker than expected jobs data. Markets pricing in 89% chance of a cut when the Fed Reserve meets next week. US jobless claims data, and we also get more inflation data, the latest personal consumption expenditure index, that's the Fed's preferred deflator, that comes out later in the week, could still influence the data-dependent FOMC, that's the Federal Open Market Committee. Well, that's it on this special edition of Global Business Insights. Thanks for watching. This is Bode Oshosami. Bye-bye.